In June 2026, SpaceX completed the largest initial public offering in history. The company raised $85.7 billion, establishing a market valuation of $1.25 trillion on its first day of trading. The momentum was immediate. From an initial offer price of $135, the stock surged to over $225 in less than a week. But 6 weeks after that debut, a strange data point emerged in the filings. 31% of the company's tradable shares had been sold short. This is a $25 billion position. At this scale, every dollar the stock price moves costs those bears roughly $200 million. Betting against Elon Musk has historically been a losing strategy. Investors who shorted Tesla over the last decade famously lost billions as the company defied their models. Why take that risk now? These short sellers see a specific structural risk in the stock's mechanics that the retail market hasn't yet accounted for. Most investors buying at the peak believed they were getting a pure play on the future of space, the reusable rockets of the launch business, and the global reach of Starlink. But the IPO actually bundled SpaceX with Musk's artificial intelligence startup, xAI. This brought the company into the world of high-cost data centers and massive computing power. That AI expansion came with a heavy price tag. xAI's massive capital spending forced SpaceX to report a net loss of $4.94 billion for 2025. To ensure the IPO succeeded despite those losses, the listing was designed with a specific market structure: manufactured scarcity. At listing, SpaceX released just 5% of its total stock to the public. When millions of retail investors bought into this tiny float, the restricted supply forced the price up mechanically to $225. The initial price surge masked the financial weight of the AI segment, setting the stage for a confrontation between retail enthusiasm and institutional math. Identifying who is behind this $25 billion bet reveals participants far more familiar with the company than standard market skeptics. Early SpaceX investors and employees hold the 95% of shares that are currently locked up. By law, they cannot sell their stock on the open market until later this year. To protect their gains while they wait, many of these insiders are shorting the public shares of their own company as a financial hedge. This locks in their paper wealth. If the stock price plummets, their short position gains value, offsetting losses on restricted shares. This means the extraordinary short interest isn't just a bet on the company's failure. It is a mechanical survival tactic used by insiders to protect their fortunes from a potential crash. That protection is temporary. The market is now approaching a deadline that threatens to break the restricted supply, the expiration of those insider lockups. This timeline tracks the incoming supply. Starting in August, a series of scheduled releases will unleash up to 5.3 billion shares. That is a 900% expansion of the stock available to trade. The bearish thesis relies on this tidal wave of supply. Short sellers expect the sheer volume of new shares to overwhelm demand, forcing the price down toward the company's fundamental value, estimated by some analysts at $50 to $60. But the bearish strategy contains a volatility trap. Packing a 31% short position into a 5% float creates a highly combustible environment. The structure has a specific trigger. If the stock price stays above $175, a large portion of those new shares is legally delayed, keeping the supply restricted for longer. If the shorts are forced to buy back shares to cover their $25 billion position while the float is still small, it would trigger a massive upward surge. The SpaceX IPO has evolved into a game of financial chicken between retail FOMO, insider wealth preservation, and institutional algorithms, with a ticking clock counting down to a historic collision.